Gurus of Chaos, a book on India's money masters by Saurabh Mukherjea, is a distillation of the wisdom of 7 of India's top money managers. Saurabh, currently head of equities at Ambit Capital, begins with a powerful analysis of the Indian equity markets. Sample this, which I read from his book. Over the past 20 years, 80% of Indian stocks have failed to give returns better than the average inflation rate, which has been 7%. However, a minority of 20% of the shares have given returns above the nominal GDP growth rate of 14%. So, the task of money managers in India is a tough one. To sift from this massive bundle of 6,000 shares and choose that 20% which will give returns. One small error and he picks one of those 80%, his returns can suffer seriously. So who are the gentlemen who have passed this test? Saurabh picks 7 outstanding money masters who have lived through the chaos and mastered it. Sanjoy Bhattacharyya, formerly CIO of HDFC AMC, Alroy Lobo, CIO of Kotak AMC, Akash Prakash, formerly of Morgan Stanley, but for many years now running his own fund, Amansa Capital, S. Naren, who has been managing ICICI Prudential's Kitty, Shashi Reddy of First State Stewart, Manjunath, who started at Canara Bank and became a trusted advisor of big Asian hedge funds, and one CIO of an iconic fund who wishes to remain anonymous. There's a lesson there. The book, together with Saurabh's own experiences, distills the wisdom and learnings of these 8 men about how to make money in the Indian markets, how to avoid the extremes of greed and fear, and how to find and stick with sustainable value. Well, first, Saurabh, let me start with what, according to you, makes fund management so treacherous? You have given us those numbers, but can you tell us what are the big challenges that fund managers face in India?
I think, Latha, as you pointed out, I think the first challenge in our country is this incredible polarity in companies. There's these 80% of the market, the vast majority of the market really, where the returns are so poor that in real terms your money actually shrinks in size if you invest in these stocks. So it's a small minority of stocks that you actually have to find to invest in. The second challenge, which is again very peculiar to India, is that amongst the world's large stock markets, we churn the most. So if you began a decade with 50 stocks in the Nifty, by the end of that 10-year period, half of them will be gone. So that sort of 50% churn rate is quite remarkable for a large stock market. And the third issue, which I think makes money managers' lives very difficult, is we are the least liquid of the world's large stock markets. So polarity of returns, high churn rate, low liquidity. Most Indian fund managers have a very, very difficult job.
So low liquidity means you have a bad stock and you're stuck with it. Even correcting your mistake is a horrendous.
Buying and selling stocks, actually, the literal act of buying and selling itself is a demanding task in our country.
Okay. Saurabh, from the portion of your book that I have read, obviously, and from what you are saying now, it is very clear, therefore, that research is perhaps the most important talent or ability that a fund manager should have. In fact, you speak about the fact that a fund manager has to do 10,000 hours of research, and just to tell you how that number comes, he speaks about 1,000 hours of research over 10 years, which means you should have done 10,000 hours of research. So let me go straight away to the man who has done something that, some research of that kind, Alroy Lobo. Alroy, exactly how much of quantity of work is needed, and what, according to you, you would look for when you research?
No, I think the first thing to look at is taking a strategic view on companies, taking a strategic view on sectors, not only for the next 1 year, but for the next 10 years. And that requires a lot of in-depth analysis. A lot of groundwork has to be done before you initiate coverage on a particular company, or for that matter, even take a position in a particular company. Because that is what builds conviction. And once you do that groundwork, you know exactly how to play the particular stock or how to play the particular sector. It takes a long time to get control over dominance of a sector. I would say minimum about 3 to 4 years to just understand the dynamics of any sector. And every year you're learning in the sector. I can't say even now that the markets don't surprise me. They do. And so it's a learning experience. We need to also be humble in the market, to accept mistakes. And every mistake should be looked as a stepping stone to actually correct and evaluate your investment philosophy.
Mr. Bhattacharya, are these lessons something you can learn from management books or from financial management books? Is this like an ROI, a return on investment, a return on capital employed? Are these the numbers to be employed? Or is it something beyond that? Reading the notes to accounts, trying to make a connect with the P&L and the balance sheet, and then going behind that to the character of the businessman himself.
What is very important, also, you spoke about, whether we get the best sort of training for being investors from conventional education. And my answer to that is, having now done it for so long, is no. Actually, it's a huge handicap to do an MBA.
Someone with a finance management degree is
I think it's actually a huge negative. Not only is it not neutral, I think it's a massive negative, because it puts into your head at a very impressionable age a bunch of really third-rate ideas. For instance, and I'll give you a very simple one, which 99% of people still believe, that higher risks lead to higher returns. It's absolute hogwash.
Okay.
I mean, the smartest, it takes a long time to realize that the smart guys are the ones who take low risks. So lower risks lead to higher returns. In fact, if you examine portfolios of fund managers across the world who've succeeded, funnily, they're all low beta portfolios, most of them. It's amazing, it's totally counter, but no one seems to learn from this.
Saurabh, let me come to the whoop and woof of the book. What exactly are the qualities that a fund manager needs?
So I think at a very practical level, the literal concepts of finance that we just discussed a few minutes ago, things like ROC, cash flow, that basic education in finance I think is necessary. But as we know, it's not just an MBA. There are several courses that one can get that from, several good books that one can get that from. What has fascinated me, and the reason I wrote this book, was what I found was that the psychological traits, the behavioral traits of great fund managers tend to be very similar, and they tend to be around immense amounts of curiosity. Great fund managers are very curious human beings. They tend to read a lot. They're very inquisitive, very questioning, very skeptical in their mindset. Allied to that is this calmness of mind, calmness of character and predisposition, which allows them to take a much more rational view of the markets rather than swaying with greed and fear like the rest of us do. And perhaps the third and final aspect which I've tried to highlight in the book is what I call iconoclasm or contrarianism. This ability to look at the world and take an independent view of the world rather than swaying with the breeze. It's a quite unique trait, and that, I think, if you ask me what's the single trait of great investors, I think that ability to take a differentiated view of the world, an independent view of the world at a time when everybody else is running helter-skelter, is probably the single most defining trait of a great fund manager. This set of characteristics is, I think, what makes a great fund manager. The basic knowledge of finance, I think, is given thankfully to a lot of us, but very few of us are able to rise to this level where our brain functions in quite this differentiated manner.
Mr. Bhattacharya, since you agreed so vehemently with him when he was speaking, how do you keep away from these extremes of greed and fear? Because selling along with the crowd and buying along with the crowd comes without any prodding. It just comes naturally to people.
I think it goes back to the realization that if you want to do well here, you can't cheat on yourself. In other words, you can't do what everyone else does and expect to be better than them.
Yep.
Okay.
So you've got to, there's a wonderful book I read many years ago which said the market cannot beat the market.
Okay.
So if you are the market, if you're doing what everyone else is doing, then how are you going to do better? So once that sort of sinks into your head, then you begin to ask yourself, what is it that I can do, as he said, differently, that may give me a chance to do better than my peer group. But just to add to what Saurabh said, I think all of what he said I have, I totally endorse. But my personal sort of learning, and what I've also observed by having the good fortune to have met a lot of, high quality people in this industry, I think 3 or 4 other things also are, to my mind, very important. The first, and to me the most important, which stands out, and you see it in every guy who has really done well, humility. You know, the market punishes hubris, arrogance very cruelly. So if you don't have genuine humility, it doesn't matter when you come a cropper, you will come a cropper. Some come a cropper quicker, some come, you know, meet their fate later, but humility, I think, absolutely basic. And then 2 or 3 other things. One, which is very important and very simple, and everyone can do it, is be patient. You know, the power of compounding is one of the most powerful things in investing. And I think Alroy mentioned it as well, that you sell too early, because fundamentally most of us are very impatient. We can't bear to do well, in a sense.
No, actually, I want to come back to you on that, because in your interview, there is a question on selling, which I thought was very interesting. We get a lot of advice on how to buy, but when to sell or what to sell is something which a fund manager perhaps equally needs to know. I'll come back to that in a minute. But Alroy, what, according to you, would you want to add to the qualities of a fund manager? And if you want to develop a little more on this courage to be a contrarian.
No, I think one is, of course, hard work, because you definitely need to spend a lot of hours evaluating, a company. You have to be a continuous learner in the market. You just can't assume that you know the company and, stay off the radar with the company, for a long period of time. If a fund manager takes leave, for example, for 6 months, he's already, obsolete in the market. So you need to be in constant touch with the market. Second is humility, and I would like to endorse that, because the market teaches you a lot of lessons. But more importantly is to stick to an investment philosophy. I think most of the returns which good fund managers tend to make are returns which are in good quality companies which have held for a long period of time. Trading in and out may get you, you may gain sometimes, you may lose sometimes. But if you're holding a company, you may have cycles. Whether the secular growth of the company is upwards, you generally see the benefits of compounding. And all these 100 companies which I have talked about, they have compounded not only in 15 years, 10 years, 7 years, 4 years, consistent returns. So it's not like a one-year story. So when you're looking at the stock, looking at the sector, you just can't take a one-year view. You need to take a much more longer-term view. And that's how you basically are able to generate superior returns, which is away from the general pack in the market.
Yes, I suppose choosing a company should also be like choosing a friend. It should not be a company whom you're ashamed to be seen with in public.
Can I just add one thing very quickly, Latha, because I think what Alroy said is really important. He spoke about it, and to my mind, all of what he said really is about discipline. And there's something which a lot of people have said, and there's this person called Michael Mauboussin who's actually written about this extensively, and it really helps in it, if you're going to make a career as a professional investor, to remember this. But it's very difficult. You asked this question, what gives you the courage to be contrary? Exactly. And in my view, this is it. Focus on process. Don't worry about the outcomes. Too many of us, as investment managers, are just obsessively concerned with outcomes. Once you manage to get your mind away from outcomes, but you're very disciplined and you're very, determined to do what you believe is necessary to invest, in a purposive manner, which is what they call process, you'll do well. And this is true across most things in life, incidentally, not just investing. So I think the idea of, it's in Hindu philosophy, it's called Maya.
Okay.
The obsession with the outcome, the attachment to the outcome. So in investing, once you get around that Maya, you're fine. And then you just need to do what works for you. And that needn't be the same for Saurabh, it needn't be the same for him. But you do what works for you, and you do it honestly and consistently. And that's it.
Well, as you can see, fund management is clearly not about numbers. It also is about a worldview. More on that from our experts in a minute after this break.